Hi there, it's Miles Pitcher again from Superior Lending. I'm excited to talk to you today about one of my favorite loans, the USDA loan. We'll run through the pros, the cons. We'll even look at how it compares against other types of loan programs so that you can figure out if this is a good fit for you, if it's the right loan program. I've been in the business now for 24 years. I own Superior Lending. Let's jump into this. So one of the pros of the USDA loan is that it is 100% loan. You can come in with zero down. Typically what I see is my clients come in, put down an earnest money deposit on the home they want to buy, and they can actually get that earnest money refunded back to them. Many times I'm seeing them ask the seller to cover the closing costs so that they don't have to come in with any additional funds. USDA has a low guarantee fee or annual fee. This is an upfront fee that is rolled into the loan amount. So you don't pay it out of pocket, out of closing, but it's rolled into the loan. It is much, much less than what you see like an FHA loan charge on theirs. It does have a lower rate than conventional because it is a government guaranteed loan. It has a lower monthly mortgage insurance amount when compared to FHA, and we love that. You can get the seller to contribute up to 6% of the purchase price that you can use for closing costs. You can use it to buy down the interest rate. You can use it, as mentioned here, to do a temporary buy down. And I'll cover that here in a minute, what a temporary buy down is. You cannot use that seller contribution towards your down payment, but you can use it to a lot of other things to your advantage. Some of the cons of the USDA loan is that it definitely has tighter debt ratios, especially if your credit score is under 680. It will really, really tighten up. The ideal client for me is a 680 plus credit score, and you have solid debt ratios on there. It is also restricted by geography. You have to be in a USDA rural area. Down in the comments, I'll pin a link to where you can go in, type your city, your zip code, your address, and see if you are in a USDA eligible area. There are also income limits. You can't make too much money. These new income limits have been released, and I'll show you where you can, I'll pin a link where you can check your income limits, and I'll show you how to read the tables on income limits. You cannot own any other real estate. So if you own another home, you're not eligible. If you have sold your old home and are buying a new one, you can do a USDA loan, assuming you meet the income limits and the geography is in a rural area. You can't do duplex to triplex or fourplex, but you can do a single family home that has a mother-in-law apartment and an accessory unit apartment. You cannot have any non-occupant co-signers on the loan. So if you're trying to buy a home, you don't qualify because of your debt ratios, your income levels. You want to get a parent to co-sign you with you. You cannot do that in a USDA loan. All right, so let me show you this. Let me make this bigger here. What we're looking at here is what the table looks like when you go in to check your income limits. You will, this is for my area where I live in. You will see, if you look at the yellow arrows, how many people are in the household. And then if you look down, see these red arrows that say moderate income guarantee loan. Okay. That is where the income limit is. So for where I'm at, we're up to a 4-person home has an income limit now of $125,350. Once you step into a 5 to 8-person home, it's $165,500. Over 8-person, they will add in more income, and you can view that on the website where it steps up from there. Salt Lake in my area, you can see, has a higher income limit and then steps all the way up to 175,000 in there. Here's some quick comparisons of USDA versus FHA versus conventional. And you can see down payment, credit score, mortgage insurance, the income limits. property location, and the loan limits. I'll let you pause and review this. I'm going to cover these basically by giving you an example here and showing you here is a $500,000 purchase, and it's going to compare 5% down conventional, FHA, 3.5% down the USDA. A couple of things I want you to note is that the conventional has a lower PMI, private mortgage insurance, than the other ones because our assumption right here in this scenario is someone with excellent credit. The worse credit score you have in conventional, the higher your mortgage insurance is going to go. Another bonus to conventional is there is no upfront fee that we've talked about, but you have a down payment and your total monthly payments around $3,078. FHA, we're looking at a 3.5% down payment, and you'll know that notice the interest rate's better on the FHA loan. The interest rate is better, but if you look at the monthly mortgage insurance, or PMI, it's the highest of all the three options. And with FHA, they do not vary that mortgage insurance based on credit score. It is a flat rate on what the monthly mortgage insurance charge is. You'll also notice that the upfront fee in FHA, $8,400, is the most expensive of all. So FHA right now is $7 worse per month in monthly payment than the conventional 5% down. If in our scenario the client had, say, a 680 credit score or even a 640, FHA would be way better than conventional. Now USDA, our favorite here. Again, no down payment. It's a 0% down. I jumped forward. The upfront guarantee fee is $5,000, and that is rolled into the loan, rolled into the mortgage, so you don't have to pay that. But you'll notice that with the 0% down, we're still $54 better per month in monthly payment than our conventional loan. So that's pretty cool. I want to show you now a comparison where we add in one more option called a temporary buy down. And on a temporary buy down, what it does is temporarily lowers the interest rate for all of year one and then all of year two. The cost of this temporary buy down is paid by the seller, and you have to ask the seller to cover that. But it's pretty awesome what it does for our clients. If I could build the perfect scenario for a client that could do a USDA loan, it would be having the seller do a temporary buy down for them. The interest rate is great. You'll notice that year one, the interest rate is not 5.75, it's going to be 3.75. And that for year one, that saves our client $602 a month. Year two, it's going to jump up to 4.75. And then year three and beyond, it'll be back to the permanent rate of 5.75. The client can refi it anytime they want, so you're not locked into this or waiting for it forever. You can refi anytime you want, but you can see how huge the monthly savings are by being able to do this USDA loan and pair it with a temporary buy down. Pretty awesome way to do it. Here's how you can get a hold of me if you have any questions on USDA loans or any loan scenarios. Thanks for checking out this video. I appreciate it. My name again is Miles Pitcher with Superior Lending.